Today we are looking at 5 stocks where insiders such as CEOs are buying shares in their own company. This is a bullish signal as it shows their confidence in the company and means they are expecting the share price to go up. We're going to run through the essential screener where we're going to be looking at companies where their market cap is 10 billion or more and where the CEOs are buying at least a 500,000 worth of shares in their company within the last 3 months. So we're going to take a look at 5 of these and we are going to run them through, look at the historical performance of each one of these companies. As always, we're going to analyze their dividend safety, their financial metrics, and we will run them through our valuation model, getting to our intrinsic value, what we see as the acceptable buy price given our investor margin of safety, and see what Wall Street have as their price targets over the next 12 months. So jumping into the first company where insiders are heavily buying, we have KDP. Now this is down around 11% over the last year. We can see it pretty much in the mid to lower point of the 52-week range with a yield of 2.7%, and we can see a forward PE of just under 18. Now over the last 10 years we can see this has been very strong. It is up around 308%, but as always bear in mind this doesn't include those dividends reinvested. Now we can see the dividend safety score of 70, market cap 45 billion, a large cap company. The dividend does look to be safe. So let's take a look at those recessionary metrics. Well, they didn't pay a dividend during the last recession, but we do know they had a above average growth of plus 44% versus the S&P's negative 12%. Dividend growth as well, a very nice 7.5% increase in September last year, above that 4% we always advocate on the channel to beat in terms of inflation. And we can see they did cut their dividend in 2015, but since 2017 it has been growing, although we do see 2019 they did maintain it. In terms of dividend yield theory, well, we can see that sign of undervaluation, 2.7% versus 2.13%. But as always, bear in mind, we're not looking at any of these models in isolation and we will draw conclusions towards the end. Forward PE, 17 versus the 5-year average of 20.9. So that is also another undervaluation signal. In terms of the sector PE, consumer staples does sit at 19.6. So KDP is lower with 16.9 forward looking. In terms of the free cash flow payout, remember, earnings is susceptible to manipulation by management through accounting. That is something for those that are new to the channel to understand. We do focus our attention on the free cash flow payout. Below 60% is my personal preference, gives me faith management are able to continually offer those double-digit increases. Now 2022, 45%, very nice to see. Below that 60%, my personal preference. But 2023, do note it is expecting to be around 85%. A bit of a red flag indicator, but it is positive to see management are guiding around 50% in 2024. In terms of the free cash flow payout, well, what we typically like to see is growing free cash flow year on year. However, for Dr. Pepper, we can notice the lower trend of 243 down to 173 in 2022, with 2024 expected to be around that same target, and 2023 that we are waiting for their annual report, it is expected to be significantly lower. So something to consider, they haven't been able to increase their free cash flow per share over the last 10 years. In terms of sales growth, well, steady moderate growth, 3 to 7% as the lower end of our target. The more recent period, actually pretty well from 2018. We see 2 years of strong double-digit increase to the top line. 2022, very nice, double-digit increase. 2023, expected 8%. Again, very positive in my opinion. And we can see, numerically speaking, they have in fact tripled their top line. 4.7 billion in 2014, 14.1 billion in 2022, with 23 expected 14.8 in fact. Shares outstanding, yes, we love it as investors when companies do share buybacks, returning excess cash to our pockets. Unfortunately, 0.16 in 2014. We see 1.3 in 2022, so they have massively diluted your position as a shareholder over the last 10 years. So again, do bear that in mind in your own investment thesis. ROIC, it is very important for me to invest in companies that have a ROIC figure of around 10% or more. It gives me faith that management are able to effectively allocate their capital. Now, the last 3 years, consistently around 7%. It isn't the greatest. I would like to see this back up to the levels we saw in 2014, 2015. But overall, from 2016, it has been fairly consistent. In terms of the operating margin and free cash flow margin, very nice to see consistently above those minimums of 16% and 7%. 2023 at 22% is nice to see, and a free cash flow margin of 9%, whilst lower than the last few years, is still above that minimum 7% we target in consumer staples industry. Net debt to earnings before interest, tax, depreciation, amortization. For those that are new, it signals the balance sheet strength as well as dividend safety. Now, we want a maximum of 4. What these numbers signal are the number of years it would take the company to pay off all of their debt net of cash on hand. 2023 expected 3.37, 2024 slightly lower, so it aren't any real issues right now, but something just to keep an eye on as it isn't too far from the maximum. Now let's jump into the valuation of KDP, and as always, if you enjoy the content, values being provided, smash the like button, it really helps the channel. Hit that subscribe and bell button if you do want to be continually notified of these videos as they drop. So typically when we do our deep dives in these companies, we do run through every single one of these models. For today's episode, we are running through 5 stocks, so let's get straight to it. The intrinsic value, therefore, is just the average of these 4 models. That comes to $36 for today's episode. In terms of the current price at $32, what we typically do, we start off with a margin of safety of 10%, which we use if we believe it has a wide moat, strong financial metrics, and good forward-looking data. We can see with a 10% margin of safety, it is a buy up to $32.43. And at 15%, we can see it isn't quite a buy yet. So for KDP, we see around a 10 to 15% margin of safety. This is one, as we mentioned on all of these stocks we're going through today, where the insiders are heavily buying a minimum of 500,000 worth of shares. So we see around 10% margin of safety. In terms of Wall Street, well, they have a price target of $36.90, even higher than our calculated intrinsic value, with around 15% upside. As always, as we do run through these stocks, do let me know if you are adding to any of these or whether or not you do not believe them to be good buys at this moment in time. Now, before we run into the second stock, what we're going to do is take a look at essentially LVMH. Now, we're not going to run through the analysis of this stock, given that we did run through it a few days ago, so do check out that detailed analysis. But one thing to point out, the CEO, Bernard, we can see he has bought from this total value over 30 million worth of shares, 30 million euros. In fact, we can see the number of shares he's bought, and this is only over the last 3 months. He has bought a significant number of shares, and the current price he has bought has been in fact slightly higher than the current trading value. So this is another stock with significant insider buying, as we can see. So let's move on to the second one we're going to do a deep dive on. It's Next Era Energy. Now, over the last year, down 29%. We can see it is in the mid to lower end of the 52-week range. Forward yield of just over 3%, and we can see a forward PE of 19.5. Over the last 10 years, whilst you would be up 178%, we can see its all-time highs towards the beginning / back end of 2021 at around $94. So let's take a look. Dividend safety score 90, very safe. Market cap 125 billion, mega cap company. Recessionary metrics, as always, very positive. Increased the dividend during the 07-09 crash. Above average growth at -9% and outperformed the S&P -31% return versus the S&P's -55%. Dividend growth, lots to love, double digit, 10% last year, which does remind us we are expecting an increase over the next few weeks, 12% over the last 5 years, 9% over the last 20 years. And when we take a look at dividend, or in fact the dividend growth, 27 years of consecutive increases, as this is more than 25 or more, they are a dividend aristocrat. Let's take a look at dividend yield theory. We can see that undervaluation sign, 3.07 versus 2.15, as well as the forward PE sitting comfortably lower than the 5-year average, a double sign of undervaluation. Although we do note the utilities sector PE is sitting lower at 16. So let's take a look at that free cash flow payout. Now for utilities, they are a lot more volatile, as you can see. So we focus on the earnings, below 75% for this industry, and positive to note back that essentially it has been even below 60% for the large part of the last 10 years. 2023 at 58%, always positive to see when that payout is lower, and we should expect another double-digit increase over the next few weeks. Earnings per share, phenomenal, just that constant increase year on year. Very nice to see, nearly 3 times from that 2013 position, with 2023 expected $3.17. Now let's take a look at the sales growth. Now we can see some of that cyclicality of the industry, but overall in those positive years we do see some years of double-digit growth to the top line, with the last 2 years looking very, very strong. And numerically speaking, it's nearly doubled their top line from 15 billion to 27.5 expected in 2023. Now, utilities industry, it is expected that they do dilute your share. The reason for this is so that they can fund a portion of their growth expenditures. And we can see it has gone up from 1.71 billion to 2.02 over the last 12 months. ROIC, we do bring this lower for utilities, around 7.5% or more. They have been struggling, as we can see, over the more recent period, but 2023 is bringing that up to around 7%, so hopefully this upward trend does continue. Now, looking at the operating margin, we can see above that 18%. Now, the last 2 years, they were pretty much straddling on that margin that we look for. 2023, though, one of their best years with a 34% margin expected. Now, net debt to EBITDA, 5.5 is what we're looking at for utilities. Very high over the last 2 years, but very positive to see this is expected to come down in 2023's report as well as 2024. Hence why we do see that very safe dividend score. Let's jump into the valuation then of NEE. And as always, you can click on the pinned comment below to grab yourself a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies, whether they're on your watch list or in your portfolio. So margin of safety at 10%, we see it's a buy up to $62.44. At 15%, not too far off the current trading price, so it is steering more towards a 15% margin of safety at around $59. In terms of Wall Street and what they see, well, they have a price target of just under $71 over the next 12 months. So Wall Street see around 16% upside to Next Era Energy. Do let me know, as I know there's a very popular one in the dividend community who do hold a lot of these shares. The next company where insiders have been buying like crazy is Air Products and Chemicals. Now this is down 14% over the last year, pretty much trading towards their 52-week lows, and it does offer a yield of 2.65% and a forward PE of just over 20. Now if you've been holding this over the last 10 years, you would be up 154%. Dividend safety score, another very safe 59 billion market cap, a large cap company. And when we talk about those recessionary metrics, while they did increase the dividend during the last recession, they did, however, have below average growth, but near enough a recession return in line with the S&P at negative 52%. Another nice increase to the dividend, 8% last year, so we are expecting one, in fact, over the next few days. Double digits over the last 5 years, double digits over the last 20 years, very, very strong to see. And we can see they are a dividend aristocrat. They have increased those dividends for 25 years or more, currently sitting at 41. Dividend yield theory then, we see that sign of undervaluation, 2.66 versus 2.25. Forward PE 20 versus 25. Again, a double sign of undervaluation. Although we do note the sector P for materials is slightly lower at 18. So let's focus on those payout ratios. So we can see in actual fact, 2022, 465%, which is why I do personally say let's always focus on free cash flow. If you were to look at the earnings at 61%, you would be completely fine. But we can see here essentially showing us in 2022, they paid out more in essential dividends than they generated in free cash flow. So something just to consider there. When we take a look at the free cash flow per share, well, we can see why the payout is negative. The free cash flow per share is also negative in 2023, although before that we can see very inconsistent over the 10-year period, and it may be worth waiting to see what the forward guidance is and how management are expecting to turn this around in your investment thesis. Sales growth, again, 2021, 2022, very positive double-digit growth. 2023, a slip of a negative 1%. So it looks like 2023 was a very tough year for Air Products and Chemicals. And if you are interested, let me know. We can do a deep dive and take a look at these numbers. Total sales then numerically, 10 billion in 2014 to around 13 in 2023. So we can see there hasn't been that much growth over the period. Share buybacks, share issuances, we can see they've pretty much diluted your position, although minimal from the last 10 years, and we can see those shares outstanding going up by around 8 million. Now, when we take a look and focus our attention on ROIC, in more positive news, it is consistently around 9 to 10%, so it is a more positive metric compared to those prior ones we have analysed. And again, on the operating margin, nice to see above 12% for every single metric. Free cash flow margin, whilst it was positive up to 2021, we can see 22 and 23 a negative margin, not really what we want to see as investors or even potential investors. Net debt to EBITDA, though, more positive, 1.92 in 2023. It was 3 as the maximum. The only thing I would say here is it has started to increase year on year, so something to keep an eye on. But 2024, it is expected to come down. So far, the balance sheet does look good, and that dividend does remain to be safe. So let's take a look at the valuation. Is it good? Is it undervalued? Insiders, nonetheless, are buying a number of shares. So intrinsic value at $306. Current price, $264. Margin of safety then at 10%, a buy at $275. 15%, pretty much not too far off the current trading price. So right now, for air products and chemicals, we are seeing around 10 to 15% margin of safety based on these estimates and judgments. What do Wall Street say? Well, they forecast a price target well above our intrinsic value at $316 with 20%. So they do believe this is a buy with a nice upside over the period. We then move on to the third company, which is GPN Global Payments Incorporated, up 19% over the last year, trading towards the mid to upper end of the 52-week range with a yield of under 1% and a forward PE of 12.53. Now, if you've owned this over the last 10 years, a fairly respectable 273% gain over this period, but we do see its all-time high at around 2021 of $217, so it is quite some way away of that currently. Dividend safety, well, 70 scores, it is safe. Market cap, 34 billion, large cap company. Recessionary metrics, well, they maintained the dividend, they didn't cut it, they didn't also increase it. Above average growth, and again a recession return which did beat the S&P 500. Dividend growth, well, this is incorrect factually, as we can see below. They have been increasing those dividends year on year. 90% over the last 5 years, 17% over the last 20 years, very, very strong, and we can see that from this graph here. From 2018, they have been continually growing that dividend with around 4 years of consecutive increases. So in terms of dividend yield theory, we can see again that sign of undervaluation both on the dividend yield perspective as well as the forward PE. And when we compare it to the financials, Global Payments pretty much sits in line with the sector PE. Now let's take a look at the free cash flow payout. Absolutely incredible, very, very low. In fact, 2023 again expected to be in line with 2022. So we should be expecting a nice dividend increase this year. Free cash flow per share, well, it has been increasing, although inconsistently, it is moving in the right direction. 78 cents in 2014, 5.92 in 2022. Expected growth in 2023, although marginal, with 2024 expecting to be a very strong year for the company. In terms of sales growth, well, 3 to 7%. However, we do see 2 years of strong double-digit growth. 2021, again, strong double-digit growth, with the last 2 years in the mid-single digits, but still isn't too bad. And when we look at it over the longer term, over the last 10 years, we can see some very positive growth from $2.5 billion in 2014 to around $9.5 billion expected to be reported in 2023. Shares outstanding, they've done it all. They've done share buybacks, they've issued shares over the period, but the net position would be share dilution from 140 million shares outstanding to 263. So let's look at the ROIC. Very inconsistent. Again, remember, you do really want to be looking at around 10% as a minimum. 2022 and 2023 at around 5% would be something that I would just continue to monitor if I was investing in this company or potentially looking to. Operating margin, free cash flow margin, much better, above that 12% consistently, 22% in 2023. Free cash flow margin as well, pretty much the same, very, very strong, 17 expected in 2023's annual report. That is shortly due to be released. Net debt to EBITDA, it is pretty much straddling around the 3 maximum that we like to see, although it has done that pretty much every single year. 3.53 expected in 2023. So whilst the dividend is safe, it is something just to keep an eye on. So let's take a look at the valuation. Don't forget, if you enjoy the content, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Current price, $130, 10% margin of safety, a buy up to 147, 15% a buy up to 138, 20% pretty much bang on the current trading price. So based on our estimates and judgments, we do see around a 20% margin of safety. What are Wall Street saying? Well, they have a price target of $150 with upside of 15% over the next 12 months. Moving on to the next company, we have Emerson Electric. Now, they are down around 5% over the last year. They are trading towards the mid to upper end of the 52-week range with a forward yield of 2.21% and a forward PE of 18. Over the last 10 years, you would be up around 35%, and we can see their all-time high in summer of 2021 at around $105, so not far off the current trading value. Dividend safety, 78, it does look to be safe. Market cap, 54 billion, a large cap company. Recessionary metrics, well, they increased the dividend during the last recession, below average growth, and a near S&P recession return. Dividend growth, not the greatest in reality, 1% over the last year, 1% on average over the last 5 years. Last 20 years at 5%, it isn't too bad, but that is quite a long time span. In terms of dividends, well, they have been increasing it for 66 years, which is a positive. They are a dividend king, but it doesn't really mean anything even if this was 200 years, if they were only increasing it very trivial amounts year on year, so something to consider. Based on dividend yield theory, we see the sign of reasonable valuation on the dividend yield, and the forward PE a slight sign of undervaluation as it sits below that 5-year average. In comparison to the industrial sector PE, Emerson Electric does sit lower at 17.8. Now, typically, again, as always, we do look at the free cash flow payout, but for this type of company, we do focus on the earnings, and we can see it is below 60% pretty much for the majority of the more recent period. 2023 at 47% is positive to note. Now, when we look at the earnings per share, $3.75 in 2014, $4.44 in 2023. It has increased, but again, it is very volatile, very inconsistent. But again, you could put that down to the nature and industry of this company. And when we look at the sales growth, we see that cyclicality right there. Years of negative growth followed by years of positive growth, and so on and so on. And as I always say on cyclical stocks, you do want to be entering or buying them when they are out of cycle and out of favor. Total sales then, it has decreased 18 billion to around 15 billion over the period. On a more positive note, they do share buybacks 704 million to 577, so they are returning that excess cash to investor pockets. Now, 10% or more we can see, whilst it is not too bad, is at 8%. One thing I would highlight, it has started to come down significantly from 2014 over that 10-year period. So again, just something to keep an eye on. And as we run through these companies, there are different metrics for different companies that I would say it is important just to keep an eye on. It doesn't mean it is a bad company or the metrics are terrible, but it is something that I would just flag as something to keep an eye on moving forward in case things do change or do get worse. Operating margin, very positive, around that 19 to 20%. Free cash flow margin, the same could be said, although 2023 it did drop. And as I said and mentioned earlier, something just to keep an eye on. And then getting to the net debt to EBITDA in more positive news, 0.16 in 2023. So that balance sheet is very strong, and that dividend does remain to be safe. So let's jump into the valuation, and as always, you can grab a copy of this model in the pinned comment below if you want to grab and you want to run your own companies through to get your own intrinsic value and acceptable buy price. So margin of safety, we start off with 10%, and we can see it isn't too far off the current value. So around $94, $95, you are looking at around a 10% margin of safety. In terms of Wall Street, well, they see a price target of $109, higher than our intrinsic value, with around 13% upside. As always, let me know your thoughts in the comments below. All of these companies have insiders, the CEOs, directors buying a significant amount of shares of $500,000 or more over the more recent period. Let me know if any of these you are considering to buy, whether or not they've been on your watch list, or in fact whether you think none of these are good at all, regardless of whether or not the CEOs are buying. As always, smash that like button if you've enjoyed today's episode. Hit the subscribe and bell button if you want to be continually notified of these videos as they drop. And as always, have a great day and catch you on the next episode.